How to use option Greeks on ETFs. Are you curious about how to effectively use option Greeks when trading exchange-traded funds? Understanding these tools can significantly enhance your trading strategy. Let's break down the key Greeks and how they apply to ETF options trading. First up is delta. Delta measures how much an option's price changes when the underlying ETF price moves by $1. For call options, delta ranges from 0 to 1, while for put options, it ranges from 0 to -1. For instance, if you have a call option with a delta of 0.5, the option's price will rise by about 50 cents if the ETF price increases by $1. Traders use delta to assess directional risk and estimate how many shares of the ETF their option position is equivalent to. This is particularly helpful for hedging or adjusting positions based on expected price movements. Next, we have gamma. Gamma measures how much delta changes when the ETF price moves by $1. It is highest for at-the-money options and decreases as options move deeper in or out of the money. Understanding gamma helps traders anticipate how their delta exposure will change as the ETF price fluctuates. This is essential for managing risk in fast-moving markets. Then there is theta, which quantifies how much an option's value declines as time passes, assuming other factors stay the same. This is known as time decay and mainly affects the option's extrinsic value. Theta is particularly important for sellers of ETF options who profit from the erosion of option premiums over time. As expiration approaches, theta typically increases, meaning the option loses value more quickly. Traders use theta to time their trades effectively. Vega measures how sensitive an option's price is to changes in the implied volatility of the ETF. Higher volatility usually leads to higher option premiums, while lower volatility results in lower premiums. Vega is vital for ETF options traders who expect changes in market volatility. If a trader anticipates volatility to rise, buying options with high Vega can be beneficial. Conversely, if volatility is expected to drop, selling options might be a smarter move. Lastly, we have rho, which measures how sensitive an option's price is to changes in interest rates. While it may not have as much impact on short-term ETF options, it can still be relevant for longer-dated options or in environments with significant interest rate changes. Now, let's look at some practical applications for ETF options trading. Using delta and gamma, traders can hedge their ETF option positions by adjusting the number of options or shares they hold to maintain a desired risk profile. Sellers of covered calls or cash-secured puts on ETFs heavily relying on theta to generate income from time decay. Understanding theta helps optimize the timing and selection of options to sell. Traders who focus on volatility can use Vega to position themselves for expected changes in ETF volatility. They might buy options when volatility is low and sell when it is high. Delta also helps estimate the likelihood of options expiring into money, aiding in selecting strike prices that align with the trader's market outlook and risk tolerance. Mastering the option Greeks allows ETF options traders to make informed decisions by quantifying how various factors affect option prices. This leads to better risk control, timing, and strategy selection in the dynamic environment of ETF options trading.